Bruce McCain is chief investment strategist at Key Private Bank, where he oversees $25 billion in assets in the great state of Ohio. Bruce, thanks for joining us here on Street Smart. Let me get your initial reaction because, as I've been saying, yesterday I saw people upping their expectations from 100 to 175,000 new jobs, and we got 18 this morning, and even an uptick in the unemployment rate. Was it a real bummer?
Well, clearly this was a miserable number, and it wasn't expected, so that wasn't good for the markets. But it looks like it's a speed bump in a rally that has made a lot of progress in a very short time, largely on expectations that the soft patch is going to ease in the coming weeks, and they just got a little ahead of themselves. There's no reason to think that we're still off track for some improvement economically with a pretty good earnings season to boot.
But Bruce, what exactly is that based on? I mean, if all the economic numbers have been lousy, what's giving people optimism that things are going to get better?
Well, there are lagging indicators, and then there are some that are more forward-looking, and employment tends to be more of a lagging indicator. But particularly when you look at the progress they're making at resolving some of the Japanese supply disruptions, when you look at energy costs and other commodity costs that have come down, there's every reason to think that we're going to see some strengthening in the economic data. What we need to see is a little bit more confidence from consumers to re-energize spending, and particularly from businesses to drive probably better employment as we look forward.
Bruce, from one man in the heartland to another, I want to tell you what Warren Buffett had to say to us in an exclusive interview today, where he's putting some of his billions of dollars, listen up. No. In fact, I'm just going to paraphrase to you because our technical equipment seems to have failed us. He's putting $4 billion into equities since February. The interesting thing is the guy he put into place there to do $1 to $3 billion has already burst through that number, and Warren said he can put as much money as he wants into equities. So how much of a positive sign is that?
Well, Warren Buffett looks to the long term, and certainly there are a lot of signs that overall the outlook over the next few years is good in a number of areas. Particularly, the United States is making a lot of progress in doing a better job of exporting, and he's focused on some of the industries that will do well. That doesn't mean that there aren't some problems that we could see over a shorter term time horizon that we'll need to deal with, but still, investing over the long term makes a great deal of sense, and he's an expert at doing that.
And by the way, although my tape just failed, we will definitely play our special at 9:30 p.m. Eastern. So viewers can be sure to check out Buffett on Bloomberg, a special tonight at, as I said, 9:30 p.m. Suzanne, Buffett's preferred companies tend to be some of the larger industrials. Tell us about them.
That's right. He, continues to favor these names. His recent acquisition, as we know, Burlington Northern, and then most recently that $9 billion purchase of Lubrizol. Today, when we talked to him, Betty Lou, they talked about a lot of things in terms of what he's looking to buy. He said he hopes to do a deal by the end of the year. He said he likes those simple companies, not technology names, but companies that he understands that have predictable cash flow, earnings, good management. Some of the names that we have come up with based on our own criteria. We searched Archer Daniels Midland. He said companies like this fit into his criteria. Also, General Dynamics is another one that continues to come up, in Exelon in the power space. So, Bruce, my question for you is, Warren Buffett likes the cyclical names. That's where he's been investing billions of dollars in terms of his past two recent acquisitions. What about Main Street investors sitting at home? Should they be taking the same long-term view that cyclicals are a good place? We've seen a big rally this year in names like Caterpillar, but you have to wonder, we continue to get weak economic data. What is your view on the sector?
Certainly, one of the spark plugs for the U.S. economy has been exports, and the industrial companies are particularly good at exploiting that. In general, we've tended to favor material stocks, industrial stocks, energy stocks that are all leveraged to that secular play. We are somewhat concerned, however, by the credit crisis in Europe and by the slowing growth that we see in overseas economies. And you've got to realize that in those economic areas, if there is a slowdown overseas, that will affect us and certainly affect those companies. And cutting back a little bit on a tactical basis, even though you remain positive longer term, may be the appropriate thing to do.
Why would you remain positive longer term? It sounds like party's over. If they're not buying our stuff and we're firing all of our workers here and hiring overseas to cut costs, at some point, the train's going to stop, right?
Well, certainly the secular trend has been to a lot of the outsourcing and growing of manufacturing capability over there without necessarily a lot of consumption to use up what's being done. But in the transition over time, they will consume more. We will be able to produce more in areas where we're more effective than they are, and it will balance out. But clearly there may be some adjustments along the way that won't be so much fun.
So, Bruce, you said that tactically it might be a good idea in the short term to cut back on some of this. And I'm curious how else you're sort of hedging your bets and expressing your caution here. Are you just sort of paring a little bit on the margins, some of your cyclical coverage, or are you also beefing up on the defensive side?
We've done some of both, but at this stage of the market, it's not so much necessarily a focus on sectors, it's a focus on individual companies and their outlook and whether or not they're doing well. So a company that has good, strong markets with pricing power, if we find a cyclical name that's working well, that's where we'll put the money. It's not necessarily a matter of bringing up the staples allocation or healthcare, although we've been doing some of that as well and trying to take off the strong bet against those defensive sectors that we had in the early part of the recovery.
Speaking of defensive sectors and healthcare, I want to bring in Sheila here. She's been looking at defensive sectors like healthcare and consumer staples. They have certainly got a lot of love from other investors lately. Sheila?
Yeah, I mean, Bruce, I have to tell you, when you look at the numbers, folks don't seem to be betting against those defensive. In fact, year to date, if you take a look at how the individual S&P sector groups have been doing, healthcare has been number one, up 13.5%. You take a look at consumer staples, up about 8%. Both of those groups, particularly healthcare, really beating the broad market as investors do seem to be taking on this defensive tilt to their portfolios. My question to you is, as you look ahead, as you are beefing up a bit, as you said, in some of these sectors, do you think that these sectors might have already had too much of a run here, or are there specific areas within those sectors that you're looking at? Like in healthcare, is there an insurance play or a medical device play that you're looking at specifically?
Again, I think it's a little bit more broad than that. Some of the higher tech areas, the Medtronics, for example, have certainly not done as well as they've done in the past. But a lot of the ones that are focused on some of the more unique niches still are doing well. Frankly, within that area, I think it's a little broader. I'm not sure that there are any specific trends that I could note at this point.
What do you expect, Bruce, from earnings next week? Because all of the guys on the floor have been saying, you know, consumer spending may be weak, jobs picture may be weak, but it doesn't really matter what goes on Main Street here as long as corporate America is making more and more money. Does that continue?
We think that it will be a good earnings season. One of the things that you need to keep in mind that part of the reason the second quarter was weak was the companies became more cautious about spending. But if they hold back on expenditures, that's usually good for profit margins. So by and large, I think that there's been a greater slowdown on the expenditure side than there has been on the revenue side, and earnings will be good. There may be some more disappointments than there would have been prior to the soft patch, but by and large, we're looking for a good earnings season.
How long does that continue? Because if they slow down spending, then other businesses aren't getting their money. If they're still not hiring people, then U.S. consumers aren't buying their stuff. And if you're worried about slowdowns in Europe and in Asia, it just doesn't look good long term, does it?
Well, longer term, that is more of a concern. The other problem, my colleague Nick Rach, who follows the corporate earnings for us, tells us that expectations as you move into the fall are probably a little bit high and need to come down. So as we get into the fall, especially if there's greater weakness overseas or failure to pick up exports here, you've got a greater chance of disappointment.
Got it.
But for the moment, next quarter looks good.
Got it. Bruce, thanks so much for joining us. Bruce McCain there from Key Private Bank.